All right, Mindset Fam, we're live again, 10:26 a.m., and we're about to do a little study session. And we're having the rest of our smoothie. Coffee number 2. I made it extra strong because I want that focus. That meditation really helps. I'm going to ride this wave of focus that the meditation created, right? We got Mega Zen this morning. And like I said, let me know in the comments if you guys want me to help you guys do a meditation and I be the guide versus my OCAP. But I can still have the OCAP on with like background music, and then I can help you guide. I think that'd be cool. I can help guide you, yeah. Where we still meditate together, but I do I have my own kind of script or help guide you through the meditation. Coffee number 2 feels good. Okay, blue light blocking glasses. I use Kino Vision. It's to help reduce eye strain when I'm on the computer. And then as soon as we hit a wall, we probably have just under an hour to do the study session before the dog. So the dog will be done in an hour and a half. So till 11, we got about till 11:30. So I'm going to power through as much reading as I can in that time. So as always, do a study me session. So I'm going to do like that. I like books. And then stay as long as you want for the study session. I'll be reading aloud and I'll have, whatchamacallit, binaural beats in the background, I believe. All right, and then smoothie. So I'll have a quick smoothie. Okay. Smoothie number 2. Need that energy for focus. Delish. Brain freeze, Mindset Fam. Drinking this too fast. I'm trying to slow down. Chugging this. Drinking the coffee while we study in a minute. Oh, brain freeze. Okay. Let's meditate. Sorry, let's study. I mean, not meditate. Here we go. I just need you. I'm just dreaming it, so I'm just dreaming it, so yeah. Unless, yeah, and then if you do, and then if you do come out with you in turn, Becky, I'll be out as soon as I hit a wall. All right, let's do this, Mindset Fam. So, we got Michael Jordan in the background, as you can see. We got freaking Arnold Schwarzenegger on the wall here. I need to get a Muhammad Ali poster next. I'm gonna ask that for my birthday next February or for Christmas. Just like a neat like a paper, right? Get like a poster of your idols on there. So let's begin. So I got to charge the Apple Watch. As soon as I hit a wall of focus, I will probably box if we got time before we go and get the dog from his haircut. But we got so close to finishing the chapter last night. I stayed up till almost 11:30 my time, Pacific. But what we're gonna do, we're gonna log in, and I'm gonna show you guys how to focus, really focus. I'm gonna again, like I said, I'm gonna read aloud because it helps me a lot. And then okay, so we got about 4 more pages, I believe. So I'm just changing it till today. And what are we at here? 10:30 in the morning. Okay. The brain is wired, the brain's ready to go. Yeah. So boom, get rid of that. There we go. Love it. Okay. I'm gonna put some binaural beats on for us too. Same ones as I always do. Because it's no copyright. And I don't know if you guys will be able to hear it, but mm, whoa. Okay. Okay. Here we go. So we're gonna go binaural beats, no copyright, no ads. Yo, what's going on, KK? We're gonna do a little study session with me. All right, here we go. Just looking for one, no ads, no music. Boom. There. So this humming, yeah, I remember you from earlier. That's awesome. Appreciate being here. Okay, let me know if you can hear this. Can you hear that? I don't know if you can hear that hum, but that's basically 40 hertz binaural beats. And this is literally what I listen to. Nope, not meditation. So this is binaural beats. It's a slight hum. You might not be able to hear it. I've got my volume cranked on my phone. But we're going to do our study session now. And I'm going to show you. This is my course that I'm taking. We'll see if Nana tunes in. But thanks for the recommendation for recommending to me to help guide the meditation. So if you want to hear me do it, I can 100% do that soon. All right. So let's begin. And the binaural beats helps me like zone out when, holy, we're like so far into this textbook now. It feels good. Okay. I made that second coffee nice and strong, and we are at 15-10. Sorry, 15-11. There. There we are. Okay, here we go. So we're almost on 15-12. So let's begin. Boom. Ownership. Hang on. Ownership. Strong and stable ownership supplies the leadership necessary to grow the business and keep employees motivated. Strong ownership provides staff with all the tools they need and sets the tone for culture and morale. It also creates an atmosphere of certainty that keeps the firm focused on providing the best investment analysis possible. Firm's business. Steady growth in clients and in assets under assets under management, AUM, is a good sign. The number of client accounts and the level of assets under management should be sufficient to enable the firm to pay for overhead, technological infrastructure, and salaries, plus bonuses and profit sharing. Another key point to consider is the diversification of the client and product list. It's not uncommon to find firms with a handful of large clients comprising the bulk of assets under management. The more diverse the client list, however, the smaller the potential negative impact on the firm's asset base if a client takes its assets away. The firm should also offer a sufficient breadth of products, given the cyclical nature of the investment industry, where one moment small cap stocks might be in favor and then value stocks in the next. It is prudent business practice to have a broad product base. Compensation 15-12. If equity, thus profit sharing, is not available to all employees, management should have well structured performance incentives in their place. Bonuses should be based on performance, aligning the interests of the fund investors with the bonuses should be based on performance, aligning the interests of the fund investors with the investment manager. It is ideal if managers are required to invest their personal money alongside that of their clients. Studies have shown that managers are more likely to outperform their benchmarks when pay is closely linked to performance. Compliance. Superior investment management organizations should possess internal checks and balances against poor practices and conflicts of interest. The integrity of the manager reflects on the quality of the firm. Good compliance practice extends to all aspects of the business. It is a lot to read. Compliance should be the domain of a senior non-investment officer. All trades made by the firm should be frequently and regularly audited. Trades made by the portfolio manager should be routed through the firm's trading desk, where transactions for buying and selling securities occur. Managers should not conduct trades for their own account, their spouses, or those of members of their immediate family. Senior investment staff should sign a disclosure statement of personal holdings. Mm. Philosophy. Another factor to consider when choosing a fund is the firm's investment philosophy. An investment philosophy is a coherent way of thinking about how markets work and how they might be incorrectly priced. Several philosophies coexist in the market, any one of which could be correct at a given time. There is no right or wrong philosophy. In other words, superior investment firms should clearly articulate their investment philosophy. The more clearly they can explain it, the more likely they will be able to execute it consistently and successfully, and the better clients can harmonize their investment philosophy and risk profile to that of the investment firm. Oh, do I have it up there? Okay, good. Equity and fixed income investment philosophies can each be classified into distinct management styles, shown in table 15.2 and 15.3. 15.2 Philosophies of equity investing. Value investing. A conservative approach to money management. Value investors want to buy a firm or equity fund for less than what the assets in place are worth. They avoid paying large premiums for growth companies and seek bargains in mature companies that are out of favor. Value investors have a better chance of succeeding if given a long time horizon, at least 5 years. Growth investing, a style concerned more about the future prospects of a firm than its present price. A firm might be trading it for more than its intrinsic value, but growing earnings are expected to increase the value beyond its current price. Yeah. Growth investors see companies and sectors entering a period of expansion. Growth sectors have limited competition, high quality research and development programs, relatively low labor costs, and strong returns on invested capital. Growth investors usually estimate earnings growth in buying on high expected future rates or high historical rates. What? Oh, really? Violation detected. For what? Use. I don't know. Oh, maybe because it's because I'm reading off my text and it's copyright. Hopefully, or is that just like a random? I can't tell. Violation detected. Uh, because the thing's not copyright, the binaural beats. Hmm, I don't understand. Notification. Oh, I just deleted it, but it just doesn't make sense. I'll check my channel, make sure everything's good. Hold on. Let's just make sure. I think that was someone's actual. Yeah, I think that was actually a. Hang on. No, doesn't say I have any copyright or anything. Content detection. Yeah. No, it does not say. I think that was someone's actual account. I'm glad I deleted them because that's super, super confusing. Apologies for that. Back to our reading. All right. Oh, but Mindset fam, check this out. Look, 347 watch hours. I need 3,000 to get monetized. I'm at 794 subscribers. We're gonna hit over 1,000 subscribers in the next 2 months, I would say, and we're at 500,000 channel views. Insane, and that's in just 2 years. It's just been 2 years for the channel of me consistently posting every day for lives and YouTube Shorts. So pretty freaking cool. Hmm? Yeah. When was this? This was June 4th. Okay. So I need to do another YouTube short soon here. Okay. All right. So how many streams have we done so far today? So we've done this on our second one. Good. Oh, whoops, sorry. There we go. Okay. No, everything looks good to me. Okay. So where were we? Growth sectors have limited competition, high quality. Yeah, we've done all that. Relatively low labor costs and strong returns on invested capital. Growth investors usually estimate earnings growth and buying on high expected future rates or high historical rates. Sector rotation. Sector rotation is a portfolio manager's attempt to profit through timing. It is based on the belief that different industries will perform well during certain stages of the economic cycle. Industries expected to outperform would be overweighted. More emphasis is placed on industry weightings than on security selection. Momentum investing. Momentum managers believe that strong gains in earnings or stock price will translate into stronger gains in earnings or stock price. They tend to use technical or quantitative stock selection models with some fundamental variables to smooth out the volatile nature of the style. It is a high risk, high return strategy. Momentum portfolios typically have high turnover rates as failing stocks are sold. Portfolios also tend to be more concentrated in certain areas of the economy than other funds. GARP, growth at a reasonable price. GARP is a value approach to buying earnings growth. GARP managers, like growth managers, seek companies with projections of growing earnings and high and increasing returns on equity, ROEs, relative to the industry average. Unlike growth managers, GARP managers avoid stocks with high PE ratios, price to earnings ratios. Nice. Thank you for the likes. If you're new here, hit that subscribe button. We go live daily for study with me, meditate with me, workouts, lunch with me, etc., and day in the lifestyle vlogs. And we're at 794 subscribers, Mindset Fam, because of all of you, because of your time, energy, and attention. And with your help, we're going to hit over 1,000 subscribers. I would say I'm projecting in the next 60 days. So keep showing up, keep commenting, keep giving your feedback and sharing. And keep giving me feedback on YouTube Shorts to create as well. My next YouTube short that I'm going to create, as recommended by Nana, who's in all the lives and she's a moderator and she's a current subscriber, is how to overcome procrastination or procrastination tactics. Asa Landini, welcome live. Thanks for tuning in. Here we go. Interest rate anticipation. This strategy involves moving between long term government bonds and very short term T bills based on a forecast of interest rates over a certain time horizon. Price sensitivity to interest rate movements uh, increases as the term to maturity increases and the coupon decreases. So, so this is on philosophies on fixed income investing, so like bonds. Security selection. Selecting bonds involves fundamental and credit analysis and quantitative evaluation of individual securities. Fundamental analysis of a bond considers the nature of the security and the potential cash flow. Credit analysis evaluates the likelihood that the payments will be received as contracted. Right on. Um, Credit analysis also considers the issuer's industry conditions, the economy, and other macroeconomic factors, as well as factors specific to the issuer. Sector trading. Traders vary the weights of different types of bonds held within the portfolio. A portfolio manager forms an opinion on the valuation of a specific sector of the bond market based on its credit fundamentals and on relative valuations compared to historical norms and technical factors such as supply and demand. Investors willing to assume interest rate risk can add return to their portfolios by holding high yielding securities from a specific sector. Process. If philosophy is the belief system on which assets are managed, process is the methodology by which value is accrued to the fund. No one process at any time can be said to be superior to another, but good investment organizations should have two outstanding qualities of a process: elements that are verifiable and transparent, decision making procedures that are team based. Processes are the tools used and the way they are coordinated to manage and grow assets. Processes can include records of company visits and manager interviews, screening and selection criteria, proprietary economic analysis, sector and stock weight ranges, maximum and minimum number of holdings, risk monitoring, and a selling discipline. Outstanding organizations demonstrate unique tools or innovative ways of combining these tools. 15-14, team-based approach. Whatever process and tools are used, mutual fund investors should favor firms that emphasize a team-based approach to managing money. Under the team-based approach, an individual may or may not have total decision-making power, but the structure of the investment process is team dependent. That means that no one individual has dominant influence on the investment process. An investment approach that emphasizes a team-based decision-making process is especially good in the context of succession planning and business continuity. Continuity is important over the long run if the firm is to profitably and reliably execute the firm's investment process despite any losses of key personnel. A firm may have a team of analysts supporting a number of portfolio managers. The team's job is to screen an initial universe of stocks down to a small group that meets the firm's valuation criteria. Though individual managers can buy any stocks within the group, they usually cannot go outside the approved list. Managers may come and go over the years, but the fund will retain a disciplined investment process because it resides with a team rather than an individual. All things equal, it is preferable to select a fund with a team-based approach than one that relies on an individual. Performance. Performance is the legacy of the investment philosophy as it is applied through the investment process by the people of the firm. Performance considers more than just added value over a given benchmark. It also accounts for a manager's consistency and frequency of relative performance plus the risk taken to get good returns. Performance also takes into consideration the consistency of investment style over time. Good management more consistently and more frequently outperforms its benchmark and his peers per unit of risk. It is easy to judge past performance, but difficult to project into the future. Style analysis is the study of style drift change in a manager's investment style over a period of time, in a fund's holdings or returns over time. Style drift is given important consideration in performance analysis for several reasons. Performance analysis was discussed in Chapter 14. For example, a small cap manager that invests in large caps during a period of small cap underperformance cannot be said to be a skillful small cap manager. The more style drift that exists in a manager's investment approach, the more difficult it becomes to separate manager's skill from sheer coincidence. Two methods of style analysis are returns-based and holdings-based. Returns-based style analysis was developed by Nobel Prize-winning economist William Sharpe. He suggested that a fund's investment style can be determined by comparing the fund's returns, usually 36 to 60 months of data, to the returns of a number of selected passive style indexes. These indexes represent different investment styles or asset classes such as large cap value, large cap growth, small cap value, government bonds, or cash equivalents. Example, the return of ABC Large Cap Canadian Equity Index Fund is compared to the S&P TSX 60 Index, which includes the 60 largest companies of the S&P and TSX Index. Holdings-based style analysis examines each stock in the portfolio and maps it to a style at a specific point in time. Style can be determined by capitalization, price-earnings ratio, or dividend yield. Once a large enough history of snapshots is generated, a profile of the fund's average style can be developed and used as the custom benchmark. Here we go. Nice. We got a case study. Oh, nice. And this is the last page of this chapter, Mindset Fam. Then we'll have a quick break. Do some push-ups. Anytime you just feel like you need a focus boost, do some stretching, do some push-ups, right? Every half hour to 45 minutes. The body needs to be moving. When I find the body needs a break, or the brain needs a break, move the body, and then it will get the brain back into gear again. And that helps me anyway, but use it, food for thought. Case study, sizing up Samantha's options, picking the right mutual fund. Samantha is meeting with mutual fund representative Christine to review her mutual fund portfolio. Samantha is a conservative investor whose portfolio's strategic asset allocation consists of 65% bonds, 30% equities, and 5% cash. In preparation for the meeting, Christine has reviewed and analyzed Samantha's mutual fund holdings. In doing so, she has determined that one of Samantha's funds is not suited for her portfolio, and she has prepared a recommendation to replace it. At the meeting, Christine explains to Samantha that during her review of Samantha's portfolio, she determined that the XYZ US Equity Fund was not an appropriate fit for her portfolio. Given Samantha's conservative investment profile, she should only be investing in a fund that consists of blue chip, high quality, dividend paying, large cap company stocks, has a lower than 1.0 beta relative to the benchmark, the S&P 500 index. Yes, I was, yeah. Oh, I glitched earlier because I was on data and the data is just not reliable on these streams. So that's why I'm back. Yeah, the data was just no good. So we tried to walk with, I've done it before and then it's choppy. So we're back at doing another study session. Has a relatively small standard deviation, is hedged to manage foreign exchange exposure to reduce return volatility, and has solid long-term track record with steady returns. Christine explains to Samantha that the XYZ US Equity Fund failed on all of these fronts based on her analysis, as it includes a number of mid-cap investments and had a beta of 1.2, standard deviation of plus or minus 19%. Does not use hedging and has had return swings that were far too big over the last 10 years. Instead, Christine recommends the LMN US Dividend Fund, which, based on her review, consists of top quality blue chip dividend paying large cap US companies with steady long term stock performance. Has a beta of 0.7 relative to the S&P 500 index benchmark, keeping volatility low. A standard deviation of plus minus 12%, one of the lowest in its peer group. Of the fund's prospectus, foreign currency exposure is fully hedged, further reducing return volatility, and has maintained steady year-to-year returns over its long existence. Samantha asks if there's any other ways to determine the quality of the fund. Christine shows her the fund's Morningstar report, highlighting for her the fund's 5-star rating based on its relative risk adjusted performance, while also noting the fund's large cap dividend stock focus. She shows Samantha the simplified prospectus, which notes the long-standing tenure of the fund manager and highlights the fund's mandate to generate a low volatility, consistent return experience for investors. Samantha is delighted with the recommendation and directs Christine to switch the funds. So this is someone that had a portfolio. They had a whole bunch of different mutual funds in their portfolio, but one of them was outside of their investment objective and went against their own personal risk tolerance. It was too high risk. So they swapped it out for another one that was more moderate risk. I know this is messages long, but here we go. When I was like, hey, 2702 Chris, welcome. Um, when I was like 5 years old, I don't remember, I fell into the basement on the cement stairs. Oh my God. Ouch. We're just finishing this chapter, Mindset fam. Yeah, that sucks. You didn't break anything. Holy. Okay, we are done. Chapter 15, Mindset fam. And now we're on mutual funds, fees, and services. Talk about fees now. There it is. We just finished chapter 15 just now. What are fees and charges of mutual funds? What are accumulation plans? Systematic withdrawal plans? How are mutual funds taxed? It's perfect. Awesome. Appreciate you all tuning in. Bro, that was a long time ago. Yeah. And how old are you now? You were 5 or 6 then. How old are you now? All right, chapter 16. Mm. Let's see how long. Oh yeah, I forgot that you said 5 years old. Not very specific, but mm. Oh, what? So you're like age 7? 1 plus? That happened when you were a baby? Oh my God. Sorry to hear that. All right. And again, if you're new here, we do study with me, lunch with me, meditate with me, workouts, etc., and day in the lifestyle vlogs. So if you're new here, hit that subscribe button. We just finished our chapter 15. Now we're into chapter 16. I'm older than 1 year old. Wow. Mm, we might have another half hour to above 10. Okay, that makes sense. Yeah. How long is this chapter? Yeah, 17 pages. Not bad. Let's see how much more we got in tank. Okay. Mutual funds charge a number of different fees. Some of them, such as management fees, are charged by all funds, while others, such as acquisition fees and redemption fees, are charged by some. The first objective of this chapter is to explore the different types of fees and charges. The second objective is to look at the special services provided by many mutual funds. These special services include accumulation and redemption plans, through which investors can regularly buy or sell mutual fund securities. A popular concept discussed in this chapter in relation to accumulation plans is dollar cost averaging. The chapter concludes with a discussion of tax implications of mutual fund ownership. To advise clients appropriately and well, a mutual fund sales representative needs a thorough understanding of mutual fund fee structures, special services, and tax implications. What are the fees and charges of mutual funds? All mutual funds. Oh, here we go. What are the fees and charges of mutual funds? Mutual funds incur two types of fees: sales charges or sales commissions, and management fees. Sales charges are the fees charged to individual investors when they buy mutual fund shares. These fees are generally called loads. Management fees are the fees payable by the fund to the fund's service providers. The management fees are charged out as expenses against the entire fund's earnings and are disclosed in the fund's facts document. All mutual funds charge management fees. Management fees are deducted from the fund's return to pay for professional management and administrative services provided to the fund. These fees depend on the nature of the fund and range on average from 0.5% of net assets per year to 3% of net assets per year or more. How old are you? What time is it in your country? It is 11:02 a.m. Pacific. Are you guys trying to guess my age? 2102. I am 33 years old. Mutual funds can be categorized on the basis of the types of sales charges or load that is levied. Sales charges are typically either front end fees paid upon the purchase of the mutual fund units or no fees at all. A sales fee that is paid upon purchase is called a front end load. Mutual funds that do not charge sales fees are called no load funds. Florence Stefan. Oh yeah, Florence Stefan. Yeah. I remember. You said I look like him. Yeah. In addition to the management fees and load charges, mutual fund investors may pay an annual charge called the trailer fee. The trailer fee is the annual fee based on a fixed percentage of assets. It is paid to mutual fund sales representatives to service existing clients rather than concentrate solely on making new sales to earn income. Trailer fees can range anywhere from 0.25% per year for money market funds to 1% per year for equity funds and are included in the overall management fees. The actual level of the sales charge levied by load funds depends on the type of fund, its sponsor, and method of distribution. The amount of money being invested and the method of purchase. Lump sum purchases versus accumulation plans spread out over a period of time. A client may be able to negotiate the front end load with the salesperson, especially if a large amount of money is involved, as this load is set by the distributor. Many mutual funds, primarily those offered by direct distribution companies, banks, and trust companies, are sold to the public on a no load basis, with little or no direct selling charges. However, some discount brokers may levy modest administration fees to process the purchase. Like other funds, no load funds charge management or other administration fees. No, I'm not 31, I'm 33. That was a good guess, though. Trying to calculate the impact of fees on mutual funds can be very complicated. The Ontario Securities Commission and Industry Canada's Office of Consumer Affairs have developed a new online calculator that allows investors to determine the impact of mutual fund fees on investment rate returns over time. The mutual fund fee impact calculator is located at getsmartaboutmoney.ca. Nice. Oh, Florence Stefan is 31. That's pretty close. I think you'll become famous in the future. Appreciate it. I may not. Who knows? Cool. It's good to know. GetSmartAboutMoney.ca. I'm gonna write that down to see all the fees charged to mutual funds. Here we go. Fees paid by individual mutual fund investors. That's true. Only God knows. Leave it up to the universe. Nice. My Apple Watch is already at 50% charged. I appreciate you guys studying with me. It motivates the hell out of me because it's like public accountability when you guys are watching me do my reading, do my review, etc. Fees paid by individual mutual fund investors. Different kinds of fees can be charged to investors when they invest in mutual funds. You must differentiate these fees when they are applied and how to calculate each of them. You should also know that mutual funds offered by direct distribution companies, banks, and trust companies are generally sold to the public on a no fee basis, no load funds, with little or no direct selling charges. The fees paid by individual investors generally include acquisition fees, redemption fees, transfer fees, and others. Oh, 100%. I'm already at 794 subs right now, and it's only, it will happen. 100%. You guys are right. I'm manifesting it. I'm working towards it. And when you're doing both, they harmonize together. You manifest to the universe, you're telling the universe what you want, and then you do the work to do it, and it will eventually happen. You just can't put a timestamp on it. You got to let it flow. Sunny Sangira, welcome. Welcome to live. Thanks for tuning in. I've seen you on the lives before. Yeah. So, acquisition fees. Acquisition fees are also called front end loads or sales charges, are charged by many mutual fund distributors. An acquisition fee is a sales charge based on the dollar value invested in a mutual fund, and it is payable at the time units of the fund are acquired. Investors should be aware that the front end load effectively increases the purchase price of the units, thereby reducing the actual amount invested. $1,000 investment in a mutual fund with a 4% front end load means that $40, 4% times 1,000 goes to the distributor by way of compensation, while the remaining 960 is actually invested. Yeah, you were in line. I say you will reach 2K or more. 100%. It will happen. It's going to take time. But here's the thing, you post every single day, which I do. I post every single day. I just need to get my shorts back. The short is the discovery engine, the live is the connection engine. So both of those together, it will cause me to skyrocket to the moon for subscribers. It'll just take time. But I'm at the point now where it's starting to develop a huge snowball, and that giant snowball is all my content, and it starts getting found by people all of a sudden, and then boom, and then the subscribers they go crazy. But it takes time, it takes years, and I'm willing, and I'm in no rush. I enjoy the process. You enjoy the process, you have the right habits, success will follow. Don't think about when, or sorry, yeah, don't think about when or how. We worry about the what. Leave the universe to think about the how. Yeah, yeah. 1 to 2, yeah. Every day is like 1 to 2 subs. Yeah, exactly. Sometimes I'm getting 10, sometimes 5, sometimes 6, sometimes 3. But almost every day is a bare minimum 2 subs a day. So right there, that's what is that? So let's just say conservatively 7 subs a week, 28 subs a month, right? Let's just say 30 subs a month, right? 30 subscribers a month, that's 360 a year. And yeah, each year I'm getting about 360 a year or more. Yeah, so it grows quickly. Sales charges must be disclosed in the fund facts document, both as a percentage and in dollars of the amount invested. In the example above, the fund facts would state that the front end load charge would be 4% of the amount purchased and $40 of the 1,000 invested. While this is not explicitly stated in the fun facts document, the $40 sales charge represents 4.17% of the amount actually invested in units, since only 960 will be invested out of the 1,000. Right. $40. Yeah. The front end load fees divided by the 960 times 100. To determine a fund's offering or purchase price per unit, when it has a front end load charge, you must first determine the net asset value per share and then make an adjustment for the load charge. Using net asset value per share of $12 and a front end load charge of 4%, the offering or purchase price per unit is calculated as follows: offering or purchase price, and then 100% minus the sales charge. So, offering price is $12 divided by 100% minus the 4%. So $12 minus 1 minus, oh yeah, 1.0 minus 0.04. So $12 divided by 96 cents or 0.96 is 12.50. So the above calculation shows that if you buy a fund with a net asset value of $12 and a 4% front end load, the fund units would actually cost you $12.50 versus $12. Note that the sales charge of 4% of the offering price is the equivalent of 4.1% of the net asset value or net amount invested. 4% of 12.50, yeah, is 50 cents. 50 cents, yeah, 4.7. So 50 cents divided by $12, 4.17%. Hey, Dabiga, welcome, welcome. Table 16.1 shows the difference between the two methods of sales charges for a $1,000 purchase. I see. Front end load acquisition fees, $20. Net amount invested in the mutual fund, $980. Front end load as a percentage of the purchase price. Front end load as a percentage of the purchase price, 2%. And then front end load as a percentage of the net amount invested, 2.04%. It is important to note that the sales charges indicated in the fun facts document are maximum charges. In many cases, investors can negotiate lower sales charges regardless of the amount they wish to invest. Competition for investment dollars is fierce, which is why these charges are almost always negotiable. You will hit 2K subs until you're like 40. Till I'm 40. You think I won't hit it until I'm age 40? You think it'll take 7 years? Based on the math? Yeah. I'd say before I'm 40, yeah. Because there's going to be days where there's certain days that'll be outliers that I get a whole bunch of subs in one YouTube short or in one live. Other fees. There are several other types of fees that mutual funds charge. These include transfer fees, are sometimes levied when mutual fund investors wish to switch investments out of one fund and into another, when those funds are managed by the same fund manager. Most no-load funds do not charge for this service, but funds that charge sales charges may charge up to 2% of the value of the assets transferred. Again, these fees are may be negotiable. Yeah, true that. True that. Some mutual funds try to discourage investors from redeeming their units soon after purchase by imposing a frequent trading charge. In some cases, no charges are applied, but investors are permitted to undertake only a limited number of trades. If the number of trades exceeds the maximum, the investor's holdings in the fund may be redeemed. If your clients hold mutual fund investments within RSPs, RIFs, or ESPs, they may have to pay annual trustee fees and administration fees for these plans. These fees typically range from $20 to $100 or more per year. Many firms waive such fees if the planned value exceeds a certain amount, such as $25,000. Some mutual fund distributors charge a one-time fee the first time an investor purchases mutual fund units. Funds that charge sales charges do not generally charge setup fees. Many fund distributors levy a charge when clients close their mutual fund accounts.
These account closing fees are sometimes waived if the account is closed because of the investor's death. Fees and expenses paid by mutual funds. Mutual funds make payments to the investment company that is responsible for distributing a particular group of funds. These fees are for services related to the administration of the funds, the operating expenses, and for investment advisory services, the management fee. In the case of one company, for example, each mutual fund must pay a percentage of its net asset value as management fee. The maximum fee range from 0.3% for the premium Canadian money market fund up to 4% for an international equity fund. These fees are stated on an annual basis, are calculated daily, and are paid monthly. Management fees in general range from a low of about 0.5% per year to a high of about 3% per year. Differences in management fees are the result, at least in part, of differences in the cost of providing services to investors. Managing a money market fund does not require as much security analysis as managing an equity fund. For example, foreign funds tend to be more costly to manage, and their management fees are higher as a result. There are operating expenses in addition to management fees that mutual funds must pay to their investment companies. These operating expenses arise from the fund's day-to-day activities and may include interest, operating and administrative costs, securities filing fees, taxes charged to the funds, legal and audit fees, trustee, custodial, and safekeeping fees, investor servicing costs, costs of financial and other reports, fund facts, and simplified prospectuses. Individual investors are not charged directly for the fees that the mutual fund must pay. All fees and expenses are charged to the fund itself, and as a result, decrease the fund's net asset value. In this way, each fund investor automatically pays a proportionate share of those charges. Mutual funds must report the management expense ratio, the annual total of all fees and expenses divided by average net assets, in the fund facts document and simplified prospectus. Because the management expense ratio includes expenses in addition to management fees, it will always be higher than the management fees stated as a percentage of the net asset value. Yeah, exactly. You never know. Can't put a timestamp on it. Got to let everything flow organically. Hang on one sec. Just want to see if I got any um, texts at all for about our dog. He's not ready yet. Okay. Boom. Total, yeah. Because the management expense ratio includes expenses in addition to management fees, it'll always be higher than the management fees stated as a percentage of the asset value. Yeah. Fees and expenses paid by fund managers. Some fees and expenses are not paid by the mutual funds, but are paid instead by the investment company that manages the fund. As a result, these fees and expenses are not borne directly by the fund investors. However, since the money paid out by the investment company must come from the management fees provided, oh, provided by the mutual funds, investors in those funds pay these fees indirectly. Many investment companies pay mutual fund distributors an amount based on the net asset value of the distributor's clients' holdings in their fund, sometimes referred to as a trailing commission or a trailer fee. This fee is meant to compensate mutual fund sales representatives and advisors for providing ongoing services to clients. This fee is also referred to in some simplified prospectuses as a service fee. Trailer fees generally follow a pattern as shown in Table 16.2. Pattern of trailer fees. Equity fee, sold with a front end load, 1%, balanced, 1%, bond, 0.5%, money market, 0.25%. Mutual fund costs, analysis, and implications. Costs are a drag on returns and are impossible to avoid. Given two funds with similar styles and mandates, you should generally select the lower cost fund. However, a fund's true cost is not easily apparent. Costs appear in two forms, explicit and implicit. I think we're going to leave it there. Mindset Fam, need a break. So 16-7. And there's how many pages left in this chapter? So 16-7. Yeah, so we got till 16-17. So what is that? 10 more pages? Yeah, we got 10 more pages. So a lot of reading. A lot of reading. Yeah, there we go. But yeah, I'm hitting a wall. How many? Oh, we're almost at an hour too. That's solid. Yeah. So, oh, hold on. Whoopsie daisies. Hang on. Nice. Hang on. I'm just gonna have some water. Very nice. Oh. Yeah. We'll leave it there. Mindset Fam. That was a good study session. We'll just chill for a little bit. Apple Watch is almost charged. Beauty. And my phone's already at 37%. Oh dear. So I gotta charge this in a minute. But we'll do a full hour stream. We're just gonna let this go a couple more minutes. So maybe I'll just read until we hit an hour. Okay. Maybe we'll just read this page and then cut it. Explicit costs are those directly borne by the investor. They fall into three categories: management fees, operating expenses, and sales charges. Management fees, the largest single expense, compensate the investment firm, known as the fund sponsor. The fees help pay for the salaries of the investment professionals and contribute to the firm's profit margin. Mhm. Operating expenses pay for the cost of running the fund and include taxes, record keeping, auditing, fees, rent, and utilities. Operating expenses typically range from 0.1% or 0.10% to 0.5. Oh, um, 0.5% of fund assets. The management fees and operating expenses are usually bundled into a single amount known as the management expense ratio, MER. The MER is the total of management fees and operating costs paid by a fund as expressed as a percentage of its average net assets. The magnitude of a given MER depends on the four factors shown in Table 16.3: the type of assets, the size of the fund manager, and trailer or service fees. Four factors affecting the management expense ratio. Types of assets managed by the fund. A money manager who primarily invests in Canadian T bills has a less complex job than one who invests in foreign equities, which is reflected in the management fees. Fees for domestic equity mandates generally run from 1.5% to 3% of fund assets. Domestic bonds 1 to 2%, foreign equity 2 to 4%, and less than 1% for index funds. Size of fund. Portfolios with fewer assets under administration, such as startups or small cap funds, are relatively more expensive to run than well established large cap funds because the smaller funds' costs are supported by a lower asset base. Manager of a fund. Some funds are managed by the fund sponsor's management team, but some fund companies farm out management of the fund to a specialist firm or a sub advisor and handle only marketing and client service. Generally, the management expense ratio of a fund managed by a sub advisor will be higher than a similar fund run by an in house management team. Trailer or service fees. These fees are paid to fund distributors such as mutual fund representatives, discount brokers, or financial advisors. The fees allow them to service existing clients and not just concentrate on new sales to earn income. A fund that does not have to pay mutual fund sales representatives or other distributors will cost less than a fund does. After management fees and operating expenses, the third type of explicit cost is the sales charges paid to mutual fund or sales representatives and financial advisors who recommend the funds to their clients. The charges are applied to the investor separately from the MER. The information on MERs and sales charges can be found in the Fund Facts document. Implicit costs. Implicit costs. The MER includes all expenses charged to the fund. However, not all expenses borne by the investors appear in the MER. Trading costs are implicit costs, measured by brokerage fees and turnover, and are not expensed in the MER. Instead, these costs are capitalized. To illustrate, a stock purchase for $1,000 plus $30 in commissions will be kept on the fund's books. Hold on. A stock purchase for $1,000 plus $30 in commissions will be kept on the fund's books as costing $10.30. This represents a higher breakdown hurdle for a manager to overcome. Mhm. Trading costs in the form of the trading expense ratio must also be shown in the Fund Facts document. The trading expense ratio represents the amount of trading commissions incurred to manage a portfolio as a percentage of the total assets of the fund. The total fund expenses are represented in the Fund Facts document is the sum of the management expense ratio and the trading expense ratio. Implicit. Right. So trading costs are not shown in the fund. Hey, popcorn Pishu. Welcome, welcome. Hey, we're just finishing up this live. We're at 62 minutes. My brain's hitting the wall. So we're going to leave it there. 16-8. 16-8. We're almost done this entire textbook, Mindset Fam. So we'll do some more reading tomorrow. Probably around in the afternoon or evening, early evening. So I will do a post to let you guys know when I go live. But appreciate being here. Appreciate your time, energy, and attention. Appreciate you being a current subscriber of the Mindset YouTube channel. And share this with someone else that needs help focusing, wants to improve their focus, wants to learn how to meditate, train, do study with me, workouts, meal prep, etc. And hit subscribe if you're new here. Thank you for the likes. Thank you for tuning in. And I'll stream again tomorrow. And I'll let you guys know the time. I don't know exactly on the time, but it'll be in the afternoon or early evening.